So, what are corporate bonds? Companies have many ways to raise funds from their normal income streams. Over the years, the need for companies to come up with cash to fund their projects, expansions, or new ventures has created many financial products that are now common in the market. Similarly, these products are the tools that allow the companies to borrow money from people. One such popular product is the corporate bond. When the company already knows how much it needs, it can issue a bond offering equivalent to that amount. When you buy their bond, you are in effect lending your money to them. You will find the specific terms and conditions in their bond offer or prospectus. Sounds simple enough, right? But there's a lot more to these bonds than meets the eye. For starters, buying a company's bond does not make you a part owner of that company. Equities have that effect, bonds will not. Since the company is technically borrowing from you, they will pay you interest over a period of time and repay you the principal at the maturity date. That date has been predetermined by the bond's issuer when they issue the bond. Most bonds will fall under three simple categories according to their maturity ranges. Short-term notes are bonds with maturity dates of up to 5 years after their issue date. Medium-term notes are bonds with maturity dates ranging between 5 and 12 years after their date of issue. Long-term bonds are bonds with maturities greater than 12 years. Note that some corporate bonds might have redemption or call features that can influence the maturity date. Aside from their maturity date, you can classify bonds according to their credit quality. There are reliable and independent credit rating agencies that analyze and rate these corporate bonds. Moody's Investor Service and Standard & Poor's provide a rating of the corporate bond issuers, giving them certain grades with respect to their credit worthiness. You might find that the companies with the lower credit ratings normally offer higher interest rates on the bonds to counter any unpopularity their low rating might create. Corporate bonds work like any other bonds but with its own specifications. The bond acts as the loan agreement between the corporate issuer, the borrower, and the investor, lender, where the bond terms indicate the conditions of the agreement. It obligates the bond issuer to repay the principal or borrowed amount on or before a specific date or maturity, and most likely, some interest. There are bonds that can mature in a year or less, short term, in 2 to 10 years, intermediate term, and in 10 to 30 years or more, long term. Sometimes they also call bonds that will mature in less than 10 years as notes. You might encounter the term face value when inquiring about bonds. It simply represents that amount that the issuer will pay the bondholder when the bond reaches its maturity date. Sometimes, bankers call it the par value. Normally, bond issuers issue their bonds in $1,000 denominations, which means that if you are a bond investor, you should expect to receive $1,000 on your bond's maturity date. Some issuers issue baby bonds with a face value of $500. We'll tell you what though, the bond's face value is often not the market price of the bond. Sometimes, you have to pay more for them upon purchase. You should take note of the normal practice when it comes to bond payments. You have to wait until the bond's maturity date to be able to receive your money back from the issuer. However, you will receive a specific amount representing the bond's interest regularly, most often on a semi-annual basis. Now, in case you are able to buy a serial bond, there will be specific principal amounts that will become due on specified dates. When you buy a bond, it will already specify the interest rate or coupon rate as a percentage of its face value. The issuer normally quotes this on an annual basis, and it does not change or fluctuate for the entire life of the bond. Here's an example. For instance, let's say you buy a bond with a 6% coupon rate from a company AAA with a face value of $1,000. This will prospectively make you receive $60 in interest payments every year or 6% of $1,000. However, most issuers pay interest 6-month installments so that if they pay the first $30 in January, the next $30 would be payable in June. You just have to look at the bond's prospectus, indenture agreement, or the bond certificate itself to see the payment schedule. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering investment in corporate bonds. We would love to know your thoughts, so feel free to share them in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get the best free financial education videos.